Here's something that should not be possible. On Friday, the United States Treasury did something it has not done since 2011. It stepped into the currency markets to defend a foreign country's money, not to help an ally look strong, not as a favor. The New York Fed sold euros on the Treasury's behalf to buy Japanese yen, working through Goldman Sachs and Morgan Stanley to do it quietly. If you're thinking, okay, but why would Washington spend real money defending Tokyo's currency? That is exactly the right question, and almost nobody is asking it out loud. Today, we're answering it. And by the end of this video, you're going to understand why a currency intervention 8,000 miles away is quietly sitting underneath your mortgage rate, your credit card APR, and the interest on whatever savings account you assume is just sitting there safely. I'm May. This is Behind the Market, and this is the video where we take the headline that sounds like it doesn't concern you, and we trace the pipe all the way back to your bank account, setting up the common belief, then breaking it. Here's the story most people carry around about a weak currency. Cheap currency, cheap exports, more sales abroad, good news for that country. That logic isn't wrong, for a while. Japan rode that exact story for years while the yen slid. But there's a line. Once a currency falls far enough, fast enough, the export benefit stops being the headline, because a country like Japan doesn't just sell to the world. It also has to buy from it. Japan imports almost all of the energy it burns. So a falling yen doesn't hand Tokyo a bonus. It hands Tokyo an energy bill that gets more expensive every single week the currency keeps sliding. That's the threshold Japan just crossed. And that threshold is the actual reason Washington got involved. Point 1. What actually happened on Friday? Let's start with what we can verify, because the details here matter more than a headline. On Friday, July 31st, the dollar had pushed the yen to nearly 164, a level not seen since 1986. Earlier that day, the Treasury quietly told a number of banks to stand ready for future action. Just the warning alone pushed the yen higher. Then it happened for real. The New York Fed sold euros and bought yen on the Treasury's behalf, executed through Goldman Sachs and Morgan Stanley. Reuters even got hold of a photo of Treasury Secretary Scott Bessent's own notepad from a cabinet meeting that weekend. It read, literally, to do, buy Japanese yen, $5 to $10 billion. Here's the but that makes this interesting instead of just a news brief. The last time the U.S. directly supported the yen was 2011, coordinating with the G7 after Japan's earthquake and tsunami. That was a humanitarian response to a natural disaster. This time, there's no earthquake. There's just a currency in free fall and a Treasury Secretary who days earlier had publicly called the yen very undervalued. When the person running U.S. currency policy says a foreign currency is undervalued, that's not a throwaway comment. That's Washington all but admitting it's uncomfortable with how far the dollar has run. So the intervention worked for about an hour. The yen jumped, then started drifting back. That's the part almost nobody covers, and it's the part that actually matters. A one-day rescue doesn't fix a structural problem. It just buys time. Which raises the obvious question. Why is Washington buying time for Tokyo at all? Point 2. Why Japan's currency is secretly about your mortgage. Here's the mechanism, laid out plainly, because this is the part that actually connects to your life. Japan is the single largest foreign holder of United States government debt on the planet, north of $1 trillion in Treasury bonds. For years, when Japan needed dollars to defend its currency, it leaned on that Treasury stockpile. There's actually a tool called the FEMA repo facility, built back in 2020, that lets Japan raise dollar liquidity by essentially borrowing against those treasuries instead of selling them outright, which softens the blow. But as the yen crisis drags on and intervention has to keep happening, at scale, the pressure to actually sell treasuries into the open market doesn't disappear. And when a major holder sells treasuries, or even threatens to, yields move. And Treasury yields are not some number that lives on a trading floor in Manhattan. The 10-year yield is currently trading close to 4.7%, and the 30-year just touched roughly 5.3%, its highest level in about 19 years since 2007. Those two numbers are the base ingredients for your mortgage rate, your auto loan rate, your credit card APR, and yes, the yield on the savings account you've been ignoring. When Japan's currency sneezes, American borrowing costs are sitting directly in the blast radius. Here's the part that should genuinely surprise you. The Federal Reserve under Chair Kevin Warsh just met and chose to hold rates steady. But 3 committee members actually dissented in favor of a hike, not a cut. Markets are currently pricing something like a 2/3 probability of a rate increase in September, not a decrease. So while everyone's been trained for years to expect the Fed to eventually cut, the live conversation right now inside the Fed is about whether rates need to go higher. That's the opposite of what most people assume is coming, and it's happening at the exact moment Japan's currency crisis is adding its own separate upward pressure on yields. Two completely different stories, a currency crisis in Tokyo and a policy fight in Washington, are pushing on the same lever at the same time, in the same direction. That alone would be worth an entire video. But there's a second pressure point stacked directly on top of it, and it's the one most coverage of this story leaves out entirely. Because it's not really about Japan at all, it's about oil. Point 3. The oil problem nobody mentions. Here's the piece almost every explainer skips. Since February of this year, the United States has been in an active, ongoing conflict with Iran, including strikes on Iranian targets carried out in direct retaliation for attacks on U.S. assets in the Middle East. This isn't a hypothetical tensions could escalate story. It has already escalated, badly enough that the Strait of Hormuz, the narrow shipping corridor that roughly 20 million barrels of oil pass through every single day, was actually disrupted earlier this year, forcing the U.S. to release oil from its emergency reserves just to keep supply steady. And here's the number that should genuinely alarm you. The Strategic Petroleum Reserve, the country's entire emergency oil cushion, has fallen to somewhere around 310 to 325 million barrels, its lowest level since 1983. That's not a slow, multi-decade drift. Since this Iran conflict began at the end of February, the reserve has dropped by more than 100 million barrels, largely because of a single release of roughly 172 million barrels tied directly to the Hormuz disruption. The government's own watchdog, the GAO, has warned that more than a quarter of what's left in that reserve isn't even available for drawdown right now because of aging infrastructure that needs repair. Sit with that for a second. The emergency reserve exists specifically for a moment like this, a real, live conflict with a country sitting on top of one of the world's most important oil choke points. And it's already sitting near a 43-year low, with a chunk of what remains physically unable to be pulled out on short notice. If Hormuz gets disrupted again, the cushion the U.S. would lean on is thinner than it's been in over 4 decades. Higher oil prices don't stay contained to gas stations. They move into shipping costs and grocery prices within weeks. So now you've got 3 forces, not 2, pulling in the same direction. A currency crisis pressuring U.S. yields upward, a Fed that's actually leaning hawkish instead of dovish, and a live energy supply risk that could reignite inflation on short notice. Any one of these would be a story. Together, they explain why the people setting U.S. monetary policy have almost no room left to maneuver. Now, here's the part of this story that I think is actually the most important, and it's the one piece almost nobody is connecting to the other 3. Because on its own, it doesn't look like a currency story or an oil story at all. It looks like a tech story. Stay with me, because this is where it all comes together. Point 4. The biggest thread. AI's trillion-dollar borrowing spree. America's largest technology companies are currently running the biggest corporate borrowing spree in modern history, and almost none of it is being paid for in cash. Through just the first half of this year, Alphabet, Amazon, Meta, Microsoft, and Oracle collectively issued roughly $159 billion in corporate bonds, a 47% jump from everything they borrowed in all of 2025 combined. By late July, once you count both debt and stock sales, that same group had raised close to $302 billion. Goldman Sachs, tracking this across global corporate bond and loan markets, put total AI-related debt issuance so far this year at roughly $489 billion, already blowing past their full estimate for all of last year. Amazon alone is now guiding toward $200 to $220 billion in capital spending this year, most of it aimed at data centers and chips. Here's why this matters to everything we just walked through. That's borrowed money, priced off the same Treasury yield curve that Japan's currency crisis and the Fed's hawkish tilt are both currently pushing upward. Every basis point that gets added to the 10-year or the 30-year because of pressure from Tokyo or from oil or from the Fed doesn't just raise your mortgage rate. It raises the cost of the debt funding the entire AI build-out that a meaningful slice of expected U.S. economic growth is currently resting on. Pull on the yen thread, the oil thread, or the Fed thread, and you're not pulling on three separate stories. You're pulling on one shared cost of capital that every one of these industries is quietly borrowing against at the same time. And on top of all of that sits the federal government's own math. The U.S. deficit is already running close to 6% of GDP, and independent projections show that climbing over the next decade, even with flat spending, purely because interest payments on existing debt compound. Every basis point Japan's crisis adds to yields makes that math worse too, which is really the honest answer to the question we opened with. Why does Washington care this much about a currency crisis 8,000 miles away? Because Japan is still the largest foreign owner of U.S. debt. And the last thing the U.S. government wants, in the middle of its own deficit spiral, is that owner ever needing to sell in a hurry, bringing it together. So, here's the full shape of it. Japan's currency crisis pressures U.S. yields upward. A Fed, instead of the rate cuts everyone was trained to expect, is actually leaning toward a hike. An active war with Iran has pushed the emergency oil reserve to a 43-year low, at the exact moment Hormuz remains a live risk. And America's biggest companies are financing a trillion-dollar AI build-out on borrowed money priced directly off those same yields. 4 headlines, 1 pipe. If you followed all of that genuinely, that's not a small thing to hold in your head at once. Most coverage of a story like this either flattens it into the yen is crashing, be scared, or buries you in bond market jargon with no thread connecting it back to your actual bills. You just walk through the real mechanism linking a Treasury Secretary's notepad in Maryland to the interest rate sitting on your own credit card statement. If this is the kind of thing you want more of, hit subscribe. This channel exists to keep doing exactly this, taking the headline that sounds irrelevant to you and tracing it back to what it actually touches in your life. What to actually watch. So what do you do with all of this? You don't need to trade currencies or guess where the yen lands next. Goldman Sachs, for what it's worth, now expects the dollar to keep climbing against the yen to 162 within 3 months, 163 within 6, and 165 within a year, even while their own models say the yen is historically undervalued. Their reasoning is simple. The intervention buys time. It doesn't fix the interest rate gap between the US and Japan that's driving the slide in the first place. What's actually worth watching isn't the daily headline out of Tokyo. It's the 10-year and 30-year Treasury yield. As long as those keep climbing, borrowing gets more expensive for everyone, from the federal government to the AI build-out, all the way down to your household budget. If you're carrying variable rate debt, or you're about to lock in a mortgage or an auto loan, that yield curve is the number that actually matters to you, not whatever happens in Tokyo tomorrow. This isn't financial advice. It's just the mechanism worth understanding before you make a decision that depends on it. One more thing before you go. We spent this whole video on the pressure Japan's currency crisis is putting on US yields. But there's a bigger version of this same story sitting just underneath it. That $1 trillion a year borrowing spree we just talked about. The one funding the entire AI build-out. If that spending ever slows, or that debt ever gets repriced, the ripple through this exact same bond market could make everything we just covered about Japan look small by comparison. That's the video I'm building next. Once you see the numbers side by side, I think you'll understand exactly why I'm calling it the bigger story hiding underneath this one. Subscribe so you don't miss it. I'll see you in the next one.